Okay, picture this. You've got your eye on a stock.
Uh-huh.
You've done the reading, you like the company, you believe in the mission. But every single time you open your brokerage app, your finger just kind of hovers over that buy button and you freeze.
Oh, yeah.
You're thinking, is this the bottom? Or am I about to catch a falling knife?
It's the classic investor's paralysis. I think
Yeah,
we've all been there. We're all terrified of being the person who buys right before the cliff edge.
exactly.
It's that biological fear of being the sucker at the table.
And that fear, it usually leads to one of two things. You either do nothing and watch the stock soar without you, which
Or if
hurts,
that hurts.
or you panic buy everything at once and then, lose sleep when it dips 2% the next morning. But today, we are unpacking a really fascinating experiment that tries to hack that psychology completely.
Yes.
We are looking at a very specific tactical approach, and it's dubbed the 120-day DCA challenge.
And what's so interesting here is that while the subject of this experiment is a specific company, SOFI Technologies, the real lesson isn't just about the ticker symbol.
Right.
It's about a structural method designed to just remove emotion from the equation. We're looking at a strategy that officially kicked off yesterday, February 18, 2026.
Right. So let's set the scene properly for you. We're looking at SOFI. And to understand why this challenge even exists, you really have to look at the chart. The source material points out that SOFI is currently sitting at what they call a massive discount.
Yeah.
We are talking about a stock that has fallen from highs of around, $32?
All the way down to approximately $20. That context is absolutely critical.
It is.
When you see a drop like that, losing more than a third of its value, the market sentiment is usually just pure fear.
Oh, for sure.
People see red, they see a downward trend, and they assume the house is on fire.
Oh.
But the whole premise of this deep dive is flipping that narrative.
Yeah.
The source argues that this isn't a disaster. It's a math problem with a very attractive solution.
I love a good math problem when the answer involves, making money. So let's unpack the potential upside here.
Okay.
The source makes a really simple but powerful point. If you buy at the current price of, say, $20, and the stock just goes back to where it was, or even just to $30, that is not a small win.
No, it certainly isn't. And this is where people get tripped up by the nominal dollar amounts. They think, oh, it's a $10 gain per share. Big deal. That's a sandwich.
Right.
But if you look at the percentages, a move from $20 to $30 is a 50% return on your investment.
50%. I mean, just to be clear for everyone listening, that is half your money back on top of your principal.
Right. And to put that in perspective, because you always need to look at opportunity cost, the source compares this directly to the S&P 500. A standard, a good year for the market might be 8%, maybe 10%. If this trade plays out as the strategy hopes, you are looking at beating the S&P 500 by 3 to 5 times over.
Wow. That's a massive difference. You'd have to wait, half a decade in a standard index fund to get what this strategy aims to capture in a single recovery swing?
That's the alpha everyone is chasing.
But, and here's the giant but, this only works if you actually buy the stock. And like we said, buying a stock that's down is terrifying.
It is. It feels unnatural. And this brings us right to the core problem the source identifies: the delusion of timing.
Oh, I felt this one. The source is pretty blunt here.
It is.
It says investors are delusional if they think they can time the exact bottom. Like, we all think we have this superpower.
It's a harsh truth, but it's a necessary one. We all have this fantasy that we will buy at the absolute lowest penny, tick perfect, right before the reversal.
I want to be that genius, yeah.
We want to be the genius who bought at $19.99 right before the rally. But the source brings in a really grounding comparison here. NVIDIA.
Yeah, this was a great reality check. Even a powerhouse like NVIDIA, a company with more data, more smarts, and more AI computing power than, arguably anyone on the planet,
Right.
they don't time their entries and exits perfectly.
Precisely. And just think about that for a second. If a trillion-dollar corporate entity with all its inside knowledge and sophisticated algorithms cannot predict the exact micro-movements of the market, why does the average investor sitting at home think they can?
Right. Why does Steve from accounting think he can outsmart the algorithm from his laptop?
Exactly. It is, statistically speaking, a fool's errand. You're playing a game you just cannot win.
So if we accept that we can't time the bottom, what do most people do? They swing to the other extreme. They get that fear of missing out.
They just like, oh.
Dump all their cash in at once. The source calls this the lump sum error.
This is one of the most dangerous habits in investing. And not necessarily because of the math, Sometimes a lump sum works out, but because of the psychology.
Okay.
Let's say you have $10,000 to invest. You lump sum it all in today at $20 because you think it's cheap.
Okay, I'm all in. I've committed my savings. I'm feeling brave.
And then tomorrow morning, the market has a bad day. Maybe some inflation data comes in hot. Maybe there's some geopolitical noise. The stock drops to 18.
Ugh.
You are immediately down a significant amount of money.
And that just feels terrible. I'm kicking myself. I'm thinking, why didn't I wait a day? I'm an idiot. I just set $1,000 on fire.
Exactly. That emotional pain leads to bad decisions. That regret is toxic.
Yeah.
You might panic sell to stop the bleeding. You might swear off investing altogether. The lump sum approach exposes you to maximum emotional volatility right out of the gate.
Right.
The source explicitly mentions getting upset when the price drops $2 the very next day. That specific pain point is what this challenge is designed to eliminate.
Okay, so enter the solution. The 120-day DCA challenge. I love the specificity of this. It's not just, buy some shares over time.
Oh.
It's a rigid protocol. Let's break down the mechanics because they are surprisingly strict.
It's incredibly structured. As we mentioned, the start date was yesterday, February 18th, 2026. The action is buying exactly 10 shares of SOFI.
Every single day.
Every single trading day. Weekends and holidays excluded, obviously markets closed. But every time that bell rings, you are buying.
Okay.
And the duration is set for exactly 120 days.
That's 4 months. Okay. Before we get to the timeline, I want to ask about the 10 shares part. Usually when people talk about dollar cost averaging, DCA, they say invest $100 a day. Fixed dollars. This is fixed shares. Does that matter?
It's a subtle but interesting distinction. If you invest fixed dollars, you naturally buy more shares when the price is low and fewer when it's high. That's the classic math of DCA.
Right.
By buying fixed shares, always 10, you are actually committing to spending more money if the stock goes up and less money if the stock goes down.
Oh, that is interesting. So if the stock tanks to $10, my daily bill is only $100.
Right.
But if it rallies to 30, my daily bill is $300.
Exactly. In a way, it's slightly more aggressive on the upside. You're sort of feeding the winner.
Mm-hmm.
But the source seems to focus less on that mathematical nuance and more on the simplicity of building the position count.
I see.
The goal is to reach a specific number of shares. It turns the investing process into a simple habit. Wake up. Market opens. Buy 10. Close out.
It effectively gamifies it. So why the 120-day timeline? Why 4 months? Why not just do this for a week? Or, drag it out for a year?
It's about finding that Goldilocks zone for volatility.
Mm-hmm.
Think about the chart we discussed. We are in a downturn.
Right.
A week is just too short. The volatility could just flush you out. If you buy for 5 days and the stock crashes on day 6, you didn't really spread your risk.
You just bought the dip that kept on dipping.
Exactly. But a year is a very long time in the markets.
Yeah.
If you spread your capital out that thin, you might miss the recovery entirely. But 120 days, 4 months, that's a sweet spot. It's long enough to smooth out the noise. It covers an entire earnings season, probably 2.
Okay.
It allows the market to cycle through short-term fears while you build the position.
And the goal, as the source puts it, is to accumulate a position with strategy rather than emotion. It's basically putting blinders on so you don't get spooked.
It turns investing into a chore in the best possible way. Chores are boring, but they get done.
Ha! True.
You aren't staring at the ticker wondering if now is the moment. The moment is every day.
But let's play devil's advocate here, or maybe the scared investor advocate. What if the market really tanks? The source mentions the fear of a death cross.
Right. A death cross. It sounds like a heavy metal band or a horror movie or something.
It sounds ominous regardless of what it is.
It is intended to be. Technically speaking, a death cross happens when the short-term moving average, usually the 50-day crosses below the long-term average, like the 200-day. Traders see it and they scream, sell. It usually implies momentum has died and a downturn is coming.
So if I'm buying this stock and a death cross happens on day 20 of my challenge, shouldn't I be terrified? The chart is screaming sell, and my strategy says buy.
Normally, yes, you'd be terrified. But here is the beauty of the 120-day strategy. The source argues that you should actually welcome the death cross.
Okay, explain that. How do you welcome a crash? That sounds completely counterintuitive.
Because you aren't fully invested yet. You're only buying 10 shares a day. So if the death cross happens on day 20 and the stock tanks from $20 down to, say, $15, what happens on day 21?
I buy 10 shares at $15.
Exactly. You're buying the same asset at a steep discount. You're lowering your average cost basis significantly. This creates a win-win scenario, which the source highlights just beautifully.
I see. Okay, so let's walk through the scenarios for the listener. Scenario A, the stock goes down.
Yep.
I'm happy because I'm picking up cheap shares and my average cost is dropping.
Correct. You're getting a bargain. And scenario B, the stock goes up.
I'm happy because the shares I bought yesterday and last week are now in the green. I'm making money.
You're already winning.
It's psychological armor. No matter what that squiggly line does, you have a reason to feel good about it.
That is the profound insight here. It's not just financial engineering, it's behavioral engineering. By spreading the investment over 4 months, you remove the fear of a temporary tank. You stop viewing red days as losses, and you start viewing them as sales.
I think that's huge. It breaks that habit of panic. The source even says it allows them to have a good laugh in the end. That's a level of chill I aspire to have with my portfolio. Oh, the market crashed. LOL, cheap shares.
And that good laugh comes from having a plan when everyone else is reacting. While the crowd is stressing over a 50-cent drop, you were just executing day 42 of the plan.
Yeah.
You've detached your emotions from the daily price action.
Let's talk about the asset itself for a second, because you can't just do this with anything, right? You wouldn't want to DCA into a company that's, going bankrupt.
That is a crucial distinction. The source is very explicit about this. They state clearly SOFI is a good company. They contrast it directly with buying some crappy penny stock.
Yeah, don't try this with a meme coin that might not exist in 4 months.
Exactly. If you DCA into a company that goes to zero, you just dollar cost average your way to bankruptcy. This strategy assumes the underlying asset has value and will recover. The source believes SOFI has massive upside. The strategy is simply the vehicle to capture that upside safely. You need the conviction that the company is solid, that $20 is actually a discount, not a fair price for a dying business.
So the strategy is the vehicle, but the asset is the engine. You need a good engine.
Correct. And SOFI fits this model well because it's high volatility, it moves a lot. This strategy works best on things that bounce around. If you did this with a boring utility stock that moves 1% a year, you're just wasting your time. You want that volatility to work for you.
Okay. So we've bought our shares, we've survived the death cross, we've accumulated our position over 4 months. What is the end game? Because one of the biggest mistakes investors make, and I'm so guilty of this, is not having an exit strategy.
Oh, yeah.
We buy, it goes up, we get greedy, it goes back down, and we lose it all. The round trip.
The round trip is tragic, but the source gives us a hard number here.
Yeah.
No ambiguity.
$30.
$30.
Yeah.
That is the target. It's clean. It's defined.
So we buy 10 shares a day for 120 days. If the stock hits 30 during that time, do we stop? Do we sell everything? The source implies the target is the exit.
The implication is that $30 is the realization of value. Whether they hit that target early, say there's a massive rally next month, or they have to wait out a downtrend well past the 120 days, the discipline remains. You don't sell at 22 because you got bored. You don't sell at 25 because you got nervous.
And crucially, you don't hold at 30 because you got greedy.
Exactly. You hold for the target, and when you hit the target, you execute. This is the hardest part for most people. Let's say SOFI hits 30. The headlines will be screaming, SOFI to 50, or SOFI to the moon.
Right.
It is incredibly hard to press sell when the hype is high.
That's why you have to decide now. You're making the decision on February 18th for your future self. It's like pre-commitment, like tying yourself to the mast of the ship so you don't jump in when the sirens call.
That's a great analogy. The source notes that if you use strategy, you are already ahead of most people in this market. And that really highlights how chaotic most people's investing style is.
Yeah.
Most people are just guessing.
Or they're reacting.
Most people are reactive investors. News comes out, they buy. Price drops, they sell. This strategy is proactive. You decided yesterday what you were going to do in April.
That's powerful.
That is a massive competitive advantage. You are building a machine to process the market volatility and spit out profit rather than trying to fight the market hand to hand.
For the listener or learner, this is obviously about SOFI. But I feel like the utility of this deep dive goes way beyond one fintech stock. If I believe in a biotech sector or clean energy or even crypto, I could apply this logic.
Oh, absolutely. The ticker symbol is interchangeable. The wisdom is in the framework. It's about recognizing that your own psychology is often the biggest liability in your portfolio.
We are our own worst enemies.
Totally. Our brains are wired to run from pain and chase pleasure. In the stock market, that means selling at the bottom because it hurts and buying at the top because it feels safe.
So if you can automate your conviction, Turn your belief in a company into a daily, boring action. You bypass the fear center of your brain.
It forces you to be humble, too. The lump sum investor is arrogant. They're saying, I know that today is the best price.
Right.
The DCA investor is saying, I don't know what the price will be tomorrow, so I'll spread my bets. Humility usually wins in the market.
It's boring, but it's profitable. And honestly, I'd take boring and rich over exciting and broke any day of the week.
I think we all would.
So let's just bring this all together. We're deep diving into the SOFI 120-day DCA challenge.
Yeah.
1, we've got a stock that's down significantly from $32 to $20. The source sees a 50% upside to get back to 30.
Yep.
2, instead of guessing the bottom, which is delusional, we are buying 10 shares a day, every single day, for 4 months.
Creating a timeline that absorbs all that volatility.
3, we welcome the red days because they lower our average cost. We don't panic at the death cross. We see it as a sale.
Right.
And 4, we have a hard exit at $30. We take the win and we walk away.
That's a complete loop. Entry, management, exit. Most people only have an entry strategy that says all three.
So as we wrap up this deep dive into the 120-day challenge, I want to leave you with a thought. We talk so much about freedom in investing, the freedom to buy what we want, when we want, the freedom to react to the news. We cherish that autonomy.
But often that freedom is just the freedom to make mistakes.
Exactly. Looking at this rigid, rule-based strategy, it raises a fascinating paradox. If strict rules like buy 10 shares every day no matter what are what actually protect your money and your sanity, could it be that the biggest risk to your portfolio isn't the market crashing?
It raises a very uncomfortable question.
Could the biggest risk be your own freedom to change your mind? Think about that next time your finger is hovering over the buy button. Thanks for listening to The Deep Dive. We'll see you in the next one.